Good afternoon, everybody, and welcome to the latest Service Department News webinar. Today's session is called US Extended Stay, Will the Bubble Burst? A slightly provocative title, and we're going to find out the answer, I'm sure. US Extended Stay has actually been one of the real shining stars of the hospitality world over the last couple of years, and we're going to have a deep dive into how the segment's been performing. My name's George. I'm editor of Service Department News and editor-in-chief at International Hospitality Media, and we are a London-based publisher of B2B news sites for the hospitality and real estate sectors, and we also organise conferences and awards. Now, this SAN webinar series is sponsored by IMS, and you can see their details in the chat to find out more about them, and we're just going to watch a quick video to find out more about what they do. Okay, thanks very much to IMS. So today's webinar is going to last an hour. We're going to have around about a 45-minute panel discussion. We'd like it to be as interactive as possible. So if you have any questions, please use the Q&A or the chat functions in Zoom, and we'll either get around to answering them towards the end of the session or as we go along, depending if they're relevant to the topic we're on at the time. Everyone who's registered for the session will receive a link to a recording of it in the next couple of days. So just to give the conversation some context, I'm just going to show a few screen grabs from stories that we've run on Service Department News over the last couple of years. Quite a few of them actually pertain to the panelists who we've got on the session today. And as you can see, they're to do with new brand launches, rebrands, investor activity in the sector and acquisitions, and also some performance data which has come from Mark at Highland Group. As you can see, there's one there that says extended stay hotels continue to lead US recovery. That was from November last year, and while there has been, and rightly so, there's been a lot of praise for how the sector has performed during and coming out of the pandemic, it's worth mentioning that this isn't actually a new thing. Here's a story about some more data from the Highland Group that came out literally a couple of weeks before the pandemic really kicked in. And occupancy across the sector there was at a 19-year high. So this fantastic performance isn't just a result of the pandemic. So let's introduce you to our panelists today. We've got a bit of a powerhouse panel going on here. What these gentlemen don't know about extended stay probably isn't worth knowing. I'm going to ask them all to introduce themselves in turn, and we'll go from left to right as we see them on the slide here. So Matt, would you like to go first? Good afternoon to you, or good morning I should say, because
good morning, good afternoon. Thanks for having me on the panel. My name is Matt Maclaire. I'm the Senior Director for Extended Stay Brands at Choice Hotels. Choice represents roughly 1 in 10 of all open hotels in the United States, and we have over 7,000 franchise hotels globally. Within the extended stay space, we're approaching 500 open hotels across 4 brands. Our Suburban Studios brand and Woodspring Suites brand in economy, and in the mid-scale space, Mainstay Suites, as well as our newly launched Everhome Suites brand. We've got 300 projects being actively developed in addition to those 500-ish that are open. And my role at Choice really has been to really create a center of excellence for extended stay within the company. In the last 5 years, we've went from 1 dedicated extended stay resource to nearly 50, and that spans real estate and development all the way through performance support, global sales, and marketing. And so I'm responsible for that strategy as well as our brand specific strategies and positioning. Thanks.
Great stuff. Thank you, Matt. Mark S., good afternoon, good morning to you.
Good morning, George, and everyone else. Thank you very much for putting this on. I'm a partner with the Highland Group. We are a hotel consulting and research firm, been doing this since 1989, and about 27 years ago, we started specializing in the extended stay sector and have been publishing annual, quarterly, and now monthly reports on the segment.
Thank you, Mark. Kurt, good morning to you.
Good afternoon, George. Good morning, everyone. A pleasure to be here, and thanks for the invitation for me to join. My name is Kurt Albert, Senior Vice President of Finance at Wyndham Hotels and Resorts. We're based out of New Jersey, and we're the world's largest hotel franchisor with nearly 9,000 hotels around the world. I've been with the organization for about 12 years in a variety of roles in the finance group. And most recently, I've been part of a cross-functional team that we stood up almost a year ago at this point, which was assembled to focus on how we could expand and enhance our presence in the extended stay space. This has ultimately led to the launch of our Project Echo, which we announced earlier this year, and I'm sure we'll get into more of that later on.
Thanks, Kurt. And finally, Mark F., and it's especially early for you, so thank you very much for coming on.
Absolutely. So my name is Mark Fraioli. I'm with Mission Hill Hospitality, a relatively new platform. We are a wholly controlled portfolio company of KSL Capital Partners, which is a Denver-based travel and leisure private equity investor with more than $6 billion in assets under management. The Mission Hill platform was created about 18 months ago with its first acquisition about 12 months ago for the purpose of owning select service hotels, which in our rubric includes the transient select service as well as extended stay. We recently completed our 19th hotel acquisition and should be at 21 by the end of the month. So my perspective on this is more as an investor and buyer rather than a franchisor. Mm-hmm. Thank you.
Thank you, Mark. So Mark S., as you mentioned, you have been compiling data on this segment for a good couple of decades now. But can you give us a kind of snapshot on how the sector has performed since the pandemic started, how it's coming out of it, and particularly how it's performing relative to other areas of hospitality?
Yes. I think, first of all, it's important to break out the extended stay sector itself into 3 components because they've performed differently. Mm-hmm. Economy, mid-price, and upscale. If you look at the economy segment and you compare it to all economy hotels, the revenue losses and RevPAR losses during 2020 were a tiny fraction of it. I think 1/5 is of the comparable RevPAR loss. If you look at mid-price against mid-price extended stay hotels against all mid-price, they also lost far less revenue, and so did upscale. But coming out into 2021, The economy segment has already surpassed 2019 RevPAR levels. We see a lot of comparative benchmarking statistics of the overall hotel industry. How is it doing compared to the last high watermark? Well, the economy segment has recovered all of its RevPAR plus about 20%. The mid-price segment has recovered all of its RevPAR and is one of the strongest performing segments of the hotel industry. The upscale extended stay hotel segment is about 91% of 2019 RevPAR currently. Now, one of the main reasons for that is the distribution of product. Upscale extended stay hotels, which account for about 40% of extended stay supply, have a much higher proportion of product in urban centers, which we all know have struggled to recover relative to the overall hotel industry. So I think that's the single biggest factor that's hindering that recovery. But it's important to also note that they are doing better than all upscale hotels. So collectively, the segment has done extraordinarily well, but there are differing performance factors within that segment.
Mm-hmm. Thanks, Mark. Matt, did you want to come in and talk about the relative performance of your brands in those segments?
Yeah, I think it's interesting what market share, and it's really the best way to think about it in terms of kind of a framework for the resiliency by category is sort of a continuum where the higher the price point, the more performance is correlated to sort of a traditional hotel, and at the lower price points, the more the fundamentals, the risk profile is more non-discretionary and almost more multifamily, and it really is sort of a hybrid of the two. And what we saw with our performance over the last 2 years is, we have roughly 45% of the market share in economy extended stay, and that's mostly WoodSpring, which I think has been the best performing brand in the industry. But really, 2020 was about the fact that our core traveler never stopped traveling. The types of folks that stay in economy extended stay hotels, they travel because they have to, not because they want to. So that non-discretionary demand really showed itself with a high floor and a quick bounce back where, by the end of 2020, we were at 2019 levels in that category. 2021, I think, is interesting because it's been about record-breaking performance. I think there was a product trial that happened in 2020 and a preference developed for extended stay. And you saw that propel us even further, where if you look at our biggest brand, WoodSpring, we hit 60% gross operating profit in the portfolio in 2021. And we had over 235 straight days of occupancy over 80%, with RevPAR up, in line with a category of about 20% over 19 levels. So it really has been incredible to see how we were able to not just get back to 2019, but really propel forward in 2021.
Mm-hmm. Thank you, Matt. Mark F., you've got quite a broad portfolio in terms of the brands and the segments. Have you noticed significant differences in how they have performed and how they've recovered?
Well, we have, and I think it's along the lines of what Mark Skinner was saying. The extended stay forms about 35% of our portfolio to date, and within that, the properties that are extended stay are actually performing a little bit behind some of our transient properties. And the reason for it is that the vast majority of our extended stay investments tend to be in corporate markets or urban centers, whereas many of our more transient lodging investments tend to be on beaches and mountains and places where people have already been vacationing for the last 12 months. And so we are seeing that differential, but we don't think that it's sustained. And certainly, these products performed very well through the downturn, through the pandemic, and compared favorably. The extended stay product compared favorably to the performance of hotels with shorter stays, and specifically because of the number of amenities that are inside the room.
Mm-hmm. Thanks, Mark. Kurt, did you want to come in on that point?
Yeah, I just wanted to add to what everyone has mentioned already is that just the strength, particularly on the economy side, that we saw, in 2021, I think for the full year across the segment as a whole, occupancies were approached almost 80%, which were levels that no other segment was even close to seeing. And going back even further, all the way through 2018, there's never been a quarter that the segment has been under 70%. So throughout the pandemic, before the pandemic, after the pandemic. And so there's not the seasonality that the rest of the kind of core hospitality industry does see. So it's just a very consistent, business model and a very consistent product, quarter after quarter.
Mm-hmm. Mark S., is this phenomenal growth and performance in the economy sector, does that have as much to do perhaps with the dynamics of the housing market in the US and a housing shortage as it does with demand for a hospitality product?
Yes, it's a significant factor. The economy segment has always essentially had a large proportion of residential guests, and you can loosely define that as anyone staying 30 consecutive nights or longer. And the housing crisis has always been here, but it's been somewhat regional. The Northeast and California have been dealing with that for many, many years. But now what we're seeing is it's basically nationwide. So there's been a significant increase in long-term guests in economy and, actually I would say lower mid-price if you were to segment it there as well. In other words, if you were to take, there's 570,000 extended stay hotel rooms in the US open today. If you were to cut that in half and take the lower priced half, there's been a significant increase in the amount of long-term guests there and rising rents. We just did some work in Tampa, which is 2 million people. I mean, it's a significant MSA. And the reports came back, and average apartment rent went up 30% in 2021 compared to 20. Well, that's going to cause significant displacement. So it is definitely a factor.
And is there a correlation, do you think, between the availability of multifamily properties and rental apartments, or it's more a price generated issue?
It's both. It's both. What you see is when apartment vacancies shrink, shall we say, in the B and C quality apartments, they then tighten up their guest acceptance criteria with deposits. They raise deposits, they increase verification of income levels and so forth. And it can push people who are on the margin into alternative accommodation. And the place of choice very often is an economy extended stay hotel. It's also important to note that economy hotels in general are also accommodating a significant portion of these of this type of guest, particularly in markets which don't have a lot of economy extended stay hotels. Once again, the Pacific, particularly California and the Northeast, have very, very low proportions of economy extended stay hotels. So in many cases, the lower priced traditional hotels are accommodating these guests.
Okay, that's interesting. Matt, did you want to come in on that point?
Yeah, Mark started to go there relative to the fact that this is, it's more widespread than just in the extended stay because of the insufficient supply of economy extended stay hotels. And I can add a data point in as well. There are about 650 STR tracks in the United States. Over 300 of them do not have any branded economy extended stay product. So the opportunity set is huge to add supply there. And relative to the housing shortage, last data that we saw was that there's 37 affordable rentals available for every 100 households that need them. So it's a trend that's going to take multiple cycles to correct for an economy extended stay, and those lower mid-priced hotels fill that gap in a lot of markets, particularly as jobs have sort of consolidated around those major kind of urban centers.
Yeah. And this is something that hasn't gone unnoticed by the big investment houses. Obviously, I guess the main story of the last couple of years has been the Blackstone and Starwood Capital acquisition of Extended Stay America for $6 billion. Those guys have also been active buying up. I think they bought a portfolio from Brookfield. Blackstone has also bought a separate portfolio from Condor, I believe. So they're clearly seeing the opportunity. Mark Skinner, is investor sentiment towards the sector as bullish as it's ever been, and what do you think we're likely to see in the next couple of years in terms of acquisitions and M&A activity?
Yes, investor sentiment is very bullish. Cap rates have gone down. Asset values on a per room basis have gone up. I think you'll continue to see that certainly in the near term. You are probably going to see some new brands spring up, maybe additional ones with a regional focus. I think you may see some acquisitions into the segment again, and brand extensions are a possibility, and then just the growth in brands as well. Yeah.
Okay, well, let's move on and talk about new brands, because Kurt's got one that's so new it hasn't even got a name yet. It's still a code name, which is quite exciting. Do you want to tell us a little bit about that, Kurt?
Yeah, of course. So Project Echo, which as you mentioned, George, is a code name, will be Wyndham's 23rd brand. It's a brand that we announced publicly about a month ago now, and for us, it's an economy extended stay product, and which is our sweet spot in terms of our portfolio. So we have about 50% of our portfolio in the economy space already, and so adding this type of brand there just made sense. So we are developing a brand that will be 100% new construction, prototypically built, and really most importantly, something that we feel will be the most efficient prototype in the industry. Something that we've worked hard on over the last 9 months to make sure, in conjunction with the developer council, we spent the time and effort to be able to build a product and spec a product that developers want to build and can build so efficiently to drive the type of returns that they are expecting. You know, we touched on in the last question about, you know, the investor and the developer sentiment in the industry. You know, what we know is that the developers of an extended stay product, particularly in the economy space, are not the same owners and developers that are buying and running and operating normal traditional transient economy and mid-scale hotels. There's a very high investment focus. It is all about driving profitability, maximizing a cash-on-cash return, and so we feel like Project Echo will do that. We've already signed our first 50 hotels with 2 strategic partners, and we are planning to have the first handful of hotels break ground later this year, which puts us into position to have hotels up and running, you know, by the end of next year in many cases, and most likely. So we see tremendous growth potential with the brand, and we've touched on some of the big players in the space, WoodSprings, the ESAs. You know, they have hotels in the hundreds from each of the brands in their portfolios, and at the same time, there is the untapped market potential within the different STR tracks that Matt touched on a few minutes ago. So we are excited. The reaction from developers has been overwhelmingly positive, and we're ready to go.
Excellent. I think Project Echo is a pretty cool name, personally. I might be tempted to stick with that, but you know more about it than I do. Matt, you also launched a new brand literally a couple of months before the pandemic kicked off, and you've also refreshed one of your brands, the Suburban Studios brand. How has the Everhome Suites flag progressed, considering the timing that you launched it?
Yeah, it's interesting. Pat was asked this question at Hunter, and he had a great metaphor where it was, you know, effectively an extended rain delay from the time we kicked it off with, you know, roughly 14 projects in the pipeline to where we are now. But we're picking up traction this year. We'll have our first Everhome Suites open in Southern California in this summer, and we'll have another 6 or 7 in the ground this year that will open next year throughout the country. And really, Everhome Suites, there's, you know, Mark talked about mid-scale extended stay, but really you could split that almost into two separate categories based on price point. And there's a big opportunity in kind of core mid-scale. Over 40% of the product is 15 plus years old, and over 50% is over 10 plus years old. So it's dated product there in core mid-scale. And most of the supply growth has really been at the upper mid-scale level with the Home 2 and newer Town Place product. And those assets, they run a much lower extended stay occupancy. It's not quite the same model that attracts the folks that Kurt mentioned that are in it for the return on cash. So Everhome is really meant to fit into that core mid-scale place, and it's built on the Woodspring chassis. And it's really the combination of Choice's mid-scale leadership and that Woodspring operating model. So we're really excited about that and should see growth really ramp up now that financing and some of the headwinds have sort of receded. And then another opportunity, we just rebranded our Suburban brand to Suburban Studios, and we've got a new visual identity and really a new go-to-market strategy for that brand. And we talked about supply-demand imbalance and the lack of economy products. There are a lot of traditional hotels that are sitting in those awesome economy extended stay markets that have just gone through 2 years of potentially sluggish performance, where the investment thesis or the repositioning thesis to move into the economy extended stay space is there. And Suburban Studios is meant to address that opportunity with what we call our kitchen in a box, where we've worked with architects, engineers, developers, contractors to figure out the cheapest, most efficient way to fit the extended stay room into a traditional hotel footprint. So we're really excited about that and having 20 in the pipeline already, and expect that to ramp up significantly in the coming months.
Okay, thanks, Matt. Kurt, Wyndham has also launched the dual branded product with Hawthorne Suites and La Quinta. Is that something that you're seeing a lot of demand for? And is this sort of double decker, as we call it over here, is this a frequent part of the market over there in the States?
It definitely is, and especially on the dual branded side. And so we're really proud and happy with the traction we've seen with our Hawthorne brand and some of the work we've done there from a prototype refresh standpoint, which from a dual brand standpoint really pairs nicely with our La Quinta and the Del Sol prototype that we have for that product. So we've got a strong pipeline there. We've got more than 30 or 40 projects in the pipeline that are on the dual branded side of things. And that does help us capture that mid-scale guest that Matt just touched on. And so between the Hawthorne product in the mid-scale, between Project Echo and the economy space, we've really rounded out our extended stay gamut of brands.
Thanks, Kurt. Mark F., as a buyer of hotels, how important to you, considering there is such demand for extended stay products at the moment, how important is it to you to have a brand over the door, or could you run them at 90% occupancy without a recognized brand?
It's a little bit of a difficult question from my perspective, because our platform was designed really to at least at the outset to focus on branded product, and so by definition that's what we're doing. But I will acknowledge that in many destination markets, it's certainly when you're traveling to a place because you want to be near the town center, or you want to be near the beach, then an independent positioning can do you just fine, and will allow you to attract similar levels of demand at much less expense. Within the world of branded hotels, I will say that some extended stay brands, and particularly the ones that we invest in, have very strong followings. And that's been that's really been attractive to us. To take one example, you could compare Residence Inn to Courtyard over the years, and their Residence Inn's RevPAR has usually been at something like a 15% premium to the Courtyard brand consistently. I looked at it 20 years ago, and it's pretty much the same premium that it is today. And so we're attracted to those, to products that can drive that kind of outsized demand.
Yeah.
One thing that's particularly interesting about some of the extended stay hotels we invest in is that the loyalty, you kind of asked about how important is brand and loyalty. And in some cases, the consumer loyalty to the brand is so great that people will build an extended stay product in a location that doesn't have extended stay business. They just want the brand loyalty.
Yeah.
And so, any airport in the United States, no matter how short the guest stay will be, is going to feature extended stay hotels because guests are simply attracted to having a larger room. They're faithful to the brand, and they like the option of being able to do more with their overnight stay in terms of dining and being able to kind of spread out than they could in a traditional hotel room. So we see the demand driven both by true extended stay needs and also just loyalty.
One of the things we're starting to see in this sector, perhaps in contrast with the general hotel sector, is having the real estate and the operations under the same ownership. Can you ever foresee a point when you get to maybe 50 or 100 hotels that you acquire an operating platform or launch your own brand?
It's hard to say. Certainly, we have our model at the present is to rely upon third-party operators to run our properties, and we have a lot of partnerships with those operators that we really value. It's the operations in the select service world can be characterized as simpler because there are fewer moving parts than a full service. But at the same time, your margin for error is usually reduced as well because the exceptional cash flow that these properties produce simply means that what you're buying is all cash flow, and you got to make sure it stays there. So we monitor the performance of our properties very carefully and directly participate in the revenue management for those properties. But so we've had a very good experience with the third-party operators that we've retained so far, and our portfolio generally is performing above where we thought it would be at this point in the calendar.
Okay, thanks, Mark. Mark S., could you give us a snapshot on what we're seeing in terms of the evolution of the physical product across the three tiers of the market?
Yeah, I mean it's becoming more residential, if you like. The decor and technology is increasing. The use of that, and it's really following the overall trend of the hotel industry in terms of the furnishings, the fixtures, and so forth, and definitely being modernized. Given Matt's comment earlier about the age of the product, there is a lot of dated product now in extended stay. This is not a new thing.
Mark, do you want to? Oh, I can see two hands raised here. Mark, I'll come to you first.
You go ahead, Mark.
So the only thing I wanted to add to that, thank you, Mark Skinner. The only thing I wanted to add to that was that over a 20 or 30 year period, we've certainly seen a dramatic change in what extended stay looks like. It was originally conceived as a more of a garden apartment type format, and now these are much tighter boxes. A typical 80s extended stay product might be a 5.5 acre site, and for example, a Generation 1 Residence Inn would have had 25% of its room inventory be 2 bedrooms. Today, you go from a 5.5 acre site down to something like 2 3/4, and it would be very typical for 90% of your inventory to be studios, with the remaining 10% to be not 2 bedrooms but 1 bedrooms. So the box is compressed. It's gotten a little bit more. It resembles a bit more a traditional hotel than some of the ones we've seen in the past, at least in the kind of upscale and upper mid-scale segments that we focus on.
Matt, our average unit size is coming down, do you think?
I think there's always going to be a focus on value engineering. particularly given just the cost pressures from a construction standpoint that we're seeing. On that new construction side, like Kurt mentioned, really this isn't a real estate investment, and so keeping that cost basis at a level where you can run that true extended stay operating model with the long length of stay, potentially lower RevPAR, but really high flow through RevPAR, and get to that cash on cash return. That's the focus. So it's really about maximizing that revenue producing square footage within the asset, particularly in our brands. And really one area that I think is emerging, and I think the pandemic accelerated it throughout the industry, but particularly within extended stay, is really turning that F&B offering into a profit center from a cost center. We've done some research, and really what it comes down to, the extended stay guest is not making decisions based on F&B at the price points where our brands are. I think we were at roughly 75% of respondents indicated they cook their breakfast in their room all or most days. And if you're running the model where your proportion of transient business is where it should be, which should be about 15% of your revenue mix in economy and about 25 to 30% in mid-scale, you want to orient towards that majority. Something that we've seen too is around technology and really providing smart fridge technology that's controlled access as a way of delivering F&B without stressing a labor model. And the last thing I would mention really is around sustainability. That is something that I think is emerging. You do see that more at the higher price points, but I think as time goes on, things that minimize energy usage and that sustainability aspect even into the physical product is going to become a component that affects purchase decision for guests.
Kurt, what are you guys doing with Project Echo that's maybe different in terms of design and specification from other brands? And are you responding to the different ways that people are working in now? For example, is there a work zone within the units?
Yeah, I think what's important is that, and what we've seen is with each new brand and each brand refresh over time, the product has naturally gotten more and more efficient, and that's especially true with everything we've tried to accomplish with Project Echo. We've got a box that can typically fit on a 2-acre piece of land or less. We've got a box that has more than 75% or about 75% of the square footage being rentable space, has the opportunity for additional profit centers that Matt touched on. And really the big also focus is, in addition to limiting the pressures that developers are seeing when the project is underway from a construction standpoint, is what can we do to minimize the impact or maximize the profitability from a labor standpoint? And so how do you efficiently design a public space to minimize the amount of actual employees need to have on a day-to-day basis while the hotel is running for their core hours? So we're working closely with our developer council that we stood up to identify where they feel there are the biggest opportunities to keep tweaking and improving the products that they have today, and are trying to combine all of that into what we've done in Project Echo.
Thanks, Kurt. Mark Skinner, F&B provision is quite an interesting concept in extended stay. Are you seeing any trends in what brands are offering?
I think Matt's point about purchasing food and beverage as opposed to getting a free breakfast at that point, I think that will develop. I think that at the upscale end, I believe that the manager's reception, that was a 4-night-a-week brand standard for almost all of them, will, I think Residence Inn has actually stopped it now. I mean, Mark, you probably know they have, haven't they? Yes. So if they've stopped it, you'll probably see that stop. It may come back in a different format. I've heard, because guest interaction, notwithstanding the pandemic, is very, very important when you've got long-term guests there. And I think there was some innovation with perhaps having a food truck come 1 or 2 nights a week and that sort of thing. But I think you'll see at the upper end, the manager's reception, at least as we knew it, is a thing of the past.
Yeah. Guest interaction is it? Sorry, go ahead.
If I could just, I think one thing we're noticing is that given the labor model and the type of operators that are predominant in this segment, they do not want to be in the F&B business. They recognize the need to deliver something for the guest, but we've got infinite possibilities on our phone through food delivery, and the adoption of that's been pulled forward. Things like food trucks, and I think what you'll see, the brands will start to figure out ways to either incorporate loyalty, earn and use into some of that, and or facilitating that for the guest in a way that's higher quality and efficient, but to do so in a way that doesn't have a P&L impact other than potentially some ADR increase because you're providing that service to the guests. So,
thanks, Mark. Mark F, go ahead. I think you wanted to come in on that one.
Yeah, I think that speaking to the as I typically am focused on the kind of upscale and upper mid-scale segments, particularly in some of the leisure locations that we own and operate, we're finding that there's been a good deal of blurring between select service and full service as well. And so certainly when you get a guest who is taken that one vacation this year and they're really kind of looking forward to having the full experience, and it happens to be at a Hampton in Myrtle Beach, then or say another extended stay property in a similar location, we're finding ourselves building out amenities that that might be full service ish in their nature, but ultimately that's specifically pointed at guests that are taken that are in leisure destinations and are looking for kind of the full experience. But as a general rule, we're finding more and more blurring between the select service and extended stay segments, and then full service, where full service is getting more compact and more efficient. Select service hotels are in cases embellishing their offerings a bit.
Yeah, thank you, Mark. Mark Skinner, what were the trends in average length of stay before the pandemic? How has the pandemic disrupted those trends, and are they normalizing now as we come out of it?
I don't track average length of stay specifically. Calibri Labs has very, very good data on that, but I would assume that it has gone up considerably, especially at lower price points, because of the increase in long-term guests. It just has to. We were looking at a group of economy extended stay hotels yesterday, and 2/3 of the room nights in that group of 6 hotels were for guests staying 30 nights or longer. And the data showed that was about 40% in 2019. So it did increase during the pandemic, but it has continued to increase, at least in this group of hotels. And I would assume if we looked at the data at lower price points, that's probably a national trend.
Kurt, would you think that tallies with what you're seeing across the Wyndham brands?
Yeah, I definitely would. What we definitely saw during the pandemic across all of our brands was just what Mark touched on, is that you had the guests and the travelers that were using the space for more of a long-term option anyway, and they were still there because that's what they needed. And you had that really sharp decline in leisure and business travel.
Kurt, your audio is...
We've lost your sound a bit there, Kurt. We'll come back to you, Kurt, but we lost your audio there, unfortunately.
Matt, can I share a couple data points?
Yeah, please do. Yeah.
So in our Woodspring brand versus 19, we saw average length of stay increase by 25%. In Suburban Studios, about 15%, and then in our Mainstay Suites brand, roughly 19%. And a lot of that, to echo Mark's point, is really in that 30+ category. And I think what we saw was that given the labor challenges with staffing hotels, that revenue management became a component of labor management, in the sense that the longer the length of stay, the fewer housekeeping hours you need to turn rooms. And so we saw some of that happen in 2020 out of necessity because that was who was traveling, but our properties have maintained higher than pre-COVID levels of call it that monthly guest and that tier 4 rate. I think it's partially from a labor perspective.
And do you have a minimum length of stay at your brands?
At our brands, we do take nightly guests. The Woodspring brand in its previous kind of version of Value Place actually didn't even allow nightly. But we have teams that are dedicated to extended stay that sort of coach our properties to sort of revenue manage towards high stock levels. But I think there is a place for some higher ADR business, provided you're not displacing 15 rooms for 5 months of a crew that's coming in. So if there's a concert or there's some compression opportunity, we do see hotels, be a little bit more aggressive and take some shorter length of stay business to juice their RevPAR. And that does optimize their bottom line performance.
Yeah, the reason I asked, because over here in Europe, where a lot of hotels weren't able to continue trading through the pandemic, and self-contained apartments and a more residential offer in a lot of cases people were using those who perhaps hadn't experienced a serviced apartment, as we would call it, or an extended stay room before with the home-like amenities. And now they are seeking them out whenever they travel, even if it's only for 1 or 2 nights, for leisure. I'm just wondering if that's a trend that's being reflected in the US. Does anybody want to come in on that one?
I'd say that's certainly the case.
Yeah, I would concur. If you look at total extended stay, it's only 10% of US hotel rooms. So it's reasonable to assume there's a lot of the traveling public out there that are actually unaware of what it is and what it does, because you offer a kitchen, you get discounts for the longer you stay, and events, catastrophic events like the pandemic displaced people into these products that they were in some cases unaware of. And now things are getting back to normal, if you like. They've now discovered something. So in effect, events like the pandemic or Hurricane Katrina or any other natural disaster creates additional demand because it's created additional awareness.
Yeah, okay. Mark, please come in on that one.
There's an interesting connection between 2 of the topics we've talked about so far. We've talked about how, yes, in many cases, consumers are using extended stay hotels for shorter stays simply out of loyalty or out of interest in having more in their room. And at the same time, we've also seen that the box has changed, and that a typical extended stay hotel today, Residence Inn, would have 90% studio suites and then the remainder just 1 bedrooms. And so really the design of the box has reacted to the behavior of the consumer. And as more and more of these hotels are filling up with people that are frankly not there for 2-3 weeks, but really 2-3 days at most, they're finding ways of offering a similar set of amenities in a more compact space. That aligns well with increasing land prices and other drivers for trying to shrink, but certainly the consumer behavior is one of those drivers.
Yeah. Matt, please come in on that point.
Yeah, it was just interesting. Mark mentioned about 10% of supply is purpose-built extended stay hotels. I think the demand overall in the US is roughly 20% of overall room night demand is coming from guests that are staying 7+ nights. So that's a massive supply demand imbalance. Mark, I think you mentioned that it's pronounced in Mid-Atlantic, Northeast, and West Coast. But when you think about that was almost pre-COVID, and coming out of COVID, you think about the emerging trends, whether it's the work from anywhere, remote worker, a quarter of all U.S. employees are still working remote, and that share is expected to double in the next 5 years. We've seen that correlate to more frequent and longer lengths of stay, and then even things like the infrastructure bill. It's driving room night demand from the core guest. So I think whereas there is that opportunity at the higher price points for the shorter term guests because of just product preference, I think what we're seeing is just a widening demand pie for true extended stay accommodations. So I think it's a great place to invest because despite supply growth, there's a lot of runway for investors to continue to allocate capital to the segment.
Mm-hmm. Mm-hmm. Kurt, did you want to finish off on that point?
Yeah, I think in terms of that guest dynamic, what we are seeing is that now the extended stay product is being used for any number of reasons, right? It is that blue collar construction. It's really anyone that has a life event that warrants a need to be away from home for an extended period of time or become home for any period of time. We touched on the rising rent and homeowner costs earlier in the session. That's another huge demand driver right now. And so it is the segment of the industry that has demand significantly outpacing supply. And I think that's where, and that's why you're seeing such activity and then ultimately the performance we're seeing.
Yeah, okay. Thanks, Kurt. Well, I think we can probably all agree that the answer to our rather cheeky session title is no, the bubble isn't about to burst. There's clearly huge demand and potential untapped audiences out there. But I'm just going to ask you in turn what you think are the potential challenges facing the sector. Are there any bumps in the road on the horizon? Mark S., would you like to kick us off on that one?
Well, I mean, a general recession, which is being discussed more frequently now than it was a couple of years ago, would certainly have some effect. The housing crisis, I mean, eventually supply and demand will, the current imbalance will smooth out, but that's not going to happen in the near term. I mean, because one of it is a supply issue on the housing side, and you can't just, it's not a spigot that you can just turn on. Mm. Geopolitical events currently, I would see that if it results in reduced travel and reduced international travel for some reason, affecting more the upscale segment than the lower price points. Really, in other words, the tailwinds are winning at the moment, I think.
Yeah, yeah. Well, it's good that you're struggling to think of anything that's a given. Anyway, Mark F., would you concur with that?
It's always hard to read the crystal ball. I think that one thing that is particularly heartening about the segment we're in is that as unforeseen events come up, and the last few recessions have all been different in character, but at whatever the reason for the recession, whatever the character of it, the extended stay has always weathered it better than its peers. And it was impressive to see over the pandemic how many extended stay hotels were doing 60% better RevPAR than their peers in one quarter. There was one pair of brands where the extended stay product was doing twice the RevPAR of its transient peers. So it's I think that part of the reason we've populated a third of our portfolio with this stuff is that we don't know what the future will hold, but we feel better going into the future with some of these assets in our portfolio.
Thanks, Mark. Matt, would you like to share?
Yeah. So I think it's a sign. I'm struggling to think of anything other than some potential constraints on that long length of stay guest in certain jurisdictions being a kind of a potential challenge for the existing supply. But I think on the flip side, really the only challenge I see is more new supply being constrained by supply chain and rising construction costs that are affecting the underwriting and really the economic viability and hitting that return threshold for some of the investors that are looking at the space. But in turn, that I think makes me more bullish on existing performance, because that supply demand imbalance is going to stay pretty wide then and allow for the continued strong occupancies, strong RevPAR, and most importantly, strong GOP and NOI. So
Kurt, Matt mentioned rising construction costs, materials prices, and so on, which we're also seeing here in Europe. One thing that the hospitality sector in general over here is really struggling with is recruitment, just finding staff. You know, wages are going up, but the people just don't seem to be there to fill a lot of roles. Presumably, this is another plus point for the extended stay sector, particularly at the economy level, because you don't need the levels of staff that you do higher up the price points.
Yeah, I think in the economy and the select service space as a whole, compared to the upper price point chain scales, the staffing challenges are not nearly what they are. You know, we expect these hotels to typically be run by a handful of people, you know, in total, you know, versus where you need dozens or hundreds in the upscale, you know, chains to actually operate a hotel that has F&B outlets and all the different amenities. You know, I think everyone kind of touched on in terms of, or struggled to touch on what that risk could be to the industry. And I think what we probably all agree with is that we may not be able to predict what it is, but whatever it is will impact this extended stay piece on a much lesser level, which is what we've seen through the pandemic, we've seen through any of the different recessionary periods. And I think that's what gives all of us optimism for just the overall performance that we're seeing now, and that should continue into the future.
Yeah. Well, I think that's a great note to end it on. Thank you all, gentlemen, for your contributions. Just going to show a couple of quick slides before we end the session. And we're also going to show the countdown clock again, because there's a lot of information in the chat. So we've got the LinkedIn contacts of all our fantastic panelists, as well as some other interesting stuff on there. So we're going to leave the session open for a couple of minutes at the end. So the next Service Department News webinar is called The Apartment of the Future, and this is where we're going to be looking at how the physical product is evolving. And the link to register for that is in the chat, or you can also scan the QR code, which is on the screen, to register. Just a quick mention that our annual Service Department Awards, now in their 7th year, are taking place in London on May the 10th. If you'd like to find out more about those and buy some tickets, it'd be great to see you there. It's a fantastic black tie do where lots of fun is had. And you can see the web address there, servicedepartmentawards.com. If you're interested in sponsoring any of our webinars or our events, please get in touch with my colleague Katie, whose contact details are on the slide and also in the chat. And I'd just like to say thanks for watching. I think it's been a fascinating session. It's an incredibly strong segment of the market, and it's one that we watch with keen interest from this side of the pond. Thanks to Mark S and Mark F, to Kurt and to Matt for their insights today. Great to have you on, guys. Thanks to you all for watching. Thanks to IMS for sponsoring, and enjoy the rest of your days. Thanks very much. Bye-bye.